So once again, good afternoon, everyone, and welcome to today's webinar, the main benefit test and other DAC6 limiting factors. Thank you for taking the time out of your busy schedule and joining us today. There is still someone who cannot hear. If the majority is hearing, I think it could be a problem. A single problem somewhere, so. Perfect, thanks, Yasmin. Excellent. Okay, so I'll continue. So my name is Anna Szkudlarek, and I'm one of the founding partners of Bluebridge Limited. I'm here with Paul Millen, who is also the founding partner of Bluebridge. And Paul is your key speaker today and shall deliver the main part of the webinar to you. We both have an extensive knowledge and experience in advising clients in regulatory matters and successfully producing regulatory reports. We created Bluebridge as your partner for DAC6 reporting services, delivering peace of mind and freedom from DAC6 through our 3 reporting services: report production, reportability analysis, and report submission and liability relief. So what we do for our clients, we help them from taking the reportable information and converting them into XML format. We also analyze the reportability of their cross-border arrangements. And if we get involved early in the stage, we also can provide liability relief by submitting the report as an intermediary for an arrangement. So our webinar today will take 1 hour. Approximately 45 minutes is dedicated to the presentation, and there will be time at the end to ask questions. If you, however, want to ask questions during the presentation, please use the chat box. Many of you have used it earlier today, so please use the same forum for asking questions. I also ask you, and the majority of you are muted, so please be muted and with your web camera off to reduce background distractions. So thank you very much for that. Then the recorded version of this webinar will be made available as well. So our webinar, this webinar is the first one of a series of 3 exclusive in-depth DAC6 webinars. The second one will cover DAC6 regime in Cyprus, and the third one we will talk about specific impact of DAC6 on fiduciaries. More about this at the end of the presentation. What we're looking at today, today we're looking at mainly at the main benefit test and how EU jurisdictions are reducing the volume of DAC6 reports. So we assume that all of you have certain level of knowledge of DAC6, and Paul will only briefly cover the DAC6 regime and the basics. We'll talk about hallmarks, but mainly focus on particularities of main benefit test. Then the limitations, and finally, what do these limitations mean for your operations in particular? With that, I hand over to Paul, and I wish you an interesting session. Thank you.
Thank you, Anna, for the kind introduction. Thank you, everyone, for joining us here today. And to any of my fellow Americans who are out there listening today, I wish you all a very happy Thanksgiving. I'm sure this is how you wanted to spend your Thanksgiving day. As Anna mentioned at the onset, this will not be a DAC6 overview or introduction to DAC6 webinar. Instead, it will be a focused deep dive into a particular topic, in this case, the main benefit test and other factors that EU member states are using to limit the volume of reportable cross-border arrangements under DAC6. Nonetheless, it will be useful for us to do a very brief refresher on what DAC6 is and how DAC6 operates in order to ensure that we're all on the same page before we get further into some of the technical matters. So, what is DAC6? Well, DAC6 is, as it's known colloquially, is officially called the Amendment to Directive 2011/16/EU on administrative cooperation in the field of taxation. What it essentially is it's a bit of a Frankenstein, right? So part of it is the OECD mandatory disclosure rules, which are the anti-CRS avoidance rules. It's taken those, it's taken some transfer pricing, anti-abuse provisions, and it's coupled these with a series of tax planning activities that the EU has deemed to be aggressive. And thus, as of the 1st of January of 2021, so about 1 month from now, in most EU jurisdictions, those that adopted the 6-month delay this summer, any cross-border arrangement, term of art arrangement, meeting one or more of these DAC6 hallmarks, which is a set of tax attributes that the EU has determined are indicative of aggressive tax planning, plus potentially a tax benefit test. Any of these arrangements that meet a hallmark and potentially the tax benefit test will qualify as a reportable cross-border arrangement, RCBA. And where you have an RCBA, you have to do reporting on that RCBA, on that reportable cross-border arrangement. The first order reporting party will be any EU connected parties that qualify as intermediaries, again, intermediaries, so term of art defined per DAC6, who are involved in the arrangement. If there are no intermediaries who can do the reporting, then the taxpayers who are affected by the arrangement, the clients of the intermediaries in most circumstances, must do the reporting. And when they do the reporting, whichever party it is, they must do the following. They must disclose specified information, not only about the transaction or the arrangement, but also about all the parties involved in it. So if you're the tax advisor, it's not just you and maybe your client, but every other intermediary, the accountants, the fiduciaries, the private bankers, the lawyers, whoever was involved in it, they need to be included in your report. And plus their clients, if they're not the same as your client, they would need to be added in there as well. These reports need to be sent to the local competent authority of the reporting party within 30 days of the initiation of the arrangement in question. So crucial here is it's not an annual reporting deadline as we typically find in tax reporting regimes or under FATCA or CRS, but rather a rolling reporting deadline that is triggered each time a new reportable arrangement is entered into. Furthermore, it's not a particularly long period. 30 days is quite tight, especially when most people will be focused on getting the arrangement in place and not reporting consequences under DAC6 derived from that arrangement. And then finally, excuse me, these reports that are sent to the local EU competent authority will then be exchanged with all the other EU member states on an automatic basis annually. So that is what DAC6 is and how DAC6 operates. Now we're going to look at the hallmark. So this is the set of attributes that the EU has deemed to be indicative of aggressive tax planning, and therefore the types of activities that the EU wants to collect more information about. As mentioned at the top, you can see the MDR, the OECD MDRs covered under Hallmark D. So these are the anti-CRS avoidance arrangements, the anti-CRS avoidance provisions of DAC6. Under Hallmark E, we can see the transfer pricing provisions. And then Hallmarks A, B, and C are more typically representative of tax shelter activities, of converting income, of moving income into lower tax jurisdictions, moving expenses into higher tax jurisdictions. and taking advantage of various loopholes within a tax code or between different tax codes in order to improve your tax position. Some of these hallmarks, as set forth here, are quite narrowly tailored. So for example, if we look at Hallmark A, we can see Hallmark A1, a confidentiality clause is included. That makes sense to me as an indicator of that something might be amiss. If there were a provision, if I were a tax authority person and there were provision, or someone told me, oh, I've signed a contract that says under no circumstances can I tell you about this arrangement, that would pique my curiosity. I'd want to know what that arrangement was about. So that makes sense. Hallmark A2, also fairly narrowly tailored. It's a contingency fee. So the advisor only gets paid if the tax benefit is ultimately obtained. That is atypical for tax advisory services, not unheard of, but typically you find it in tax shelter activities. So those two, they make sense to me. They're fairly narrowly tailored, but as we can see from Hallmark A3, that these hallmarks will veer towards the extremely broad in scope. And Hallmark A3 says substantially standardized documentation, not customized to that particular client. With financial transactions, that's virtually every single transaction that we enter into. We're all familiar with checking a box saying we accept the terms and conditions on a website, including our banking websites. That implies that every single transaction that we enter into on that website is based on standardized, non-customized documentation. So you can imagine this is a virtually limitless category of arrangements that has very little to do with aggressive tax planning as it currently stands. With that in mind, the EU added a second level test to most of the hallmarks under hallmarks A, B, and C. And you can even argue that the ones that don't have the test inherently embedded in the hallmark. And what this main benefit test does is it adds some tax flavoring to these activities. So it's no longer sufficient for it just to be a financial transaction. It has to be a financial transaction that has a tax dimension to it before it can even be contemplated as reportable for purposes of DAC6. So for those hallmarks that are subject to the main benefit test, which is 9 of the 20 total hallmarks, a cross-border arrangement must also satisfy the main benefit test in order to qualify as a reportable cross-border arrangement. So in this sense, it's intended to work as a limiting factor. You would weed out a lot of activities that the tax authorities are not interested in. However, the language in the text itself is perhaps too broad to serve as an effective limiting factor. So if you look over to the right of your screen, you can see the definition. And the definition reads, the main benefit test will be satisfied if it can be established that the main benefit or one of the main benefits, which, having regard to all relevant facts and circumstances, a person may reasonably expect to derive from an arrangement is the obtaining of a tax advantage. So put more simply, is one of the things you want from this transaction the tax benefit that you're going to get from it. Critically, though, the benefit need not be the sole benefit or even the primary benefit, but simply one of the main benefits you get from the arrangement. And if you break it down further, you can see some of the language in the main benefit test doesn't really ask what it poses an objective standard for this analysis. So it is irrelevant whether your motive in entering into that transaction was completely divorced from the tax benefits you were going to get. Perhaps you sent all that money to the Cayman Islands because you love palm trees and fruity drinks and white sand. But looking at it objectively, you can also see that you obtained a serious tax benefit from the sharply reduced tax rates between Cayman and wherever you currently live. So looking at that objectively, it's irrelevant why you actually did it, but what an objective, reasonable person would perceive to be one of the benefits, one of the main motivations for the activity. The consequence of this objective standard and the expansion or the limitation of the benefit test, the main benefit test, to one of the main benefits is that it's not going to function particularly well as a limiting factor. It's not going to exclude a lot of activities that are going to be not of interest to the tax authorities. And so since this language was first released, the commentators, the pundits, the affected parties, I mean, you can look back to an article that I co-authored in 2018, and we're already talking about how the MBT needs to be enhanced as a limiting factor, or else the risk is that the EU tax authorities will get an avalanche of reported cross-border arrangements that they have no interest in, that are so commonplace as to be devoid of interest for the tax authorities. So in that way, we have been waiting since then to find out how the EU member states will go about limiting the volume of reports, either by enhancing the main benefit test or through some other way, perhaps specifically going through each of the hallmarks and limiting each one. And the answer to the question of what they have done is both. And we're going to find out how in the second part of the webinar now. Now, before we go about dismantling the main benefit test, it's definitely worthwhile to look at some of the key components of the language. And the first one is, what do we mean when we say a tax benefit? If something has to be a main or one of the main tax benefits, what are the tax benefits of which we're talking about? Well, generally speaking, there's a trifecta of tax benefits. There is exemption, there is reduction, and there is deferral. So in the first one, and each one of these sort of avoidance of a negative tax outcome has a flip side, which is the enhancement of the positive tax outcome. However, as we all know, the positive tax outcomes are significantly in the minority of incidences, and so we focus more on the avoidance of the disadvantage. So when we talk about exemption, we mean, can you find a way to structure the situation so that you're no longer subject to a certain type of taxation, hence exempt from it? The flip side of that, on the positive side, would be somehow making yourself eligible for a tax refund that you otherwise would not be eligible for. So that's exemption. Then we have reduction. So finding a way to reduce the applicable rate of tax to whatever your activity is, or the amount of income that will be treated as taxable income and thus subject to that particular tax. The flip side of that is, of course, if you can find a way to increase the amount of a tax refund, that would also be a tax benefit. Then the third category is deferral. So postponing the date on which you actually need to make the cash payment of the tax that you owe. This could include avoiding the application of a withholding levy so that you don't have to make the tax payment today, but you can make it when you make your normally scheduled tax payments at the end of your tax year or calendar year, April 15th or whatever the day will be. And the positive flip side of that would be somehow to accelerate a tax repayment or a tax refund through artificial means. But again, when we're talking about tax benefits, the trifecta of tax benefits is exemption, reduction, and deferral. So not most, but some of the tax authorities have listed these specifically in their guidance. And I think they are really what we're talking about when we're talking about the tax benefits across all jurisdictions and universally when we talk about tax benefits. Now, there's some specific points that we've seen regarding the MBT, which are of interest, but are not uniformly adopted throughout the EU member states. So in certain jurisdictions, the tax advantage is not limited to direct taxes like income tax, but can also concern indirect taxes like VAT. Again, this is some EU member states have adopted this position, others have adopted the opposite position. Others say that you don't have to obtain the tax advantage in a DAC6 jurisdiction. So let's say you're making an arrangement where you make a payment from the UK to Cayman. And as a result of this payment to Cayman, you obtain a tax advantage in Cayman. That, under certain rules, would not qualify because you did not get the tax advantage in the EU member state. However, it is absolutely critical to keep reading in the guidance because in certain places where I've seen that position adopted, I've also seen the clear corollary to that, which is if you make that transaction I just described, sending money over to Cayman and getting the tax advantage there, chances are you've reduced your taxable income in the UK or in the EU member state, and that qualifies as a tax benefit. So even if the actual law you're looking at is in a non-EU jurisdiction, you're still getting a tax benefit in the EU jurisdiction, and therefore this would satisfy potentially the main benefit test, would not be excluded from it. So you've got to be careful. What they give with one hand, sometimes they take away with the other. And the final point I want to illustrate before we get going into the technical thickets is something I've seen only in one guidance so far. And I paused when I read it because it seemed a little bit madcap, but in thinking it through, I think it's not, maybe brilliant is a bit strong, but absolutely critical. And that is that the tax advantage, it qualifies as a tax advantage if it is stymieing or preventing a tax disadvantage that would otherwise arise in the future. For example, due to an amendment in the tax code. Now, most clearly, this could be a situation in which the legislature has passed an amendment to the tax code. It has yet to come into effect. You institute your cross-border arrangement, and you say, well, as of today, the trigger date for DAC6, there is no tax benefit because the law doesn't allow for the tax benefit I'm going to get in a couple months' time, and therefore it's not reportable. Under this provision, it would be reportable. I think it could also be fair to take the position that where you see a future tax disadvantage that you think is highly likely to take place, even if there's not yet been the necessary legislation for it, I think that could also qualify. So as a current day example, as many people will know, Donald Trump's tax bill in 2017 reduced the US corporate tax rate to 21%. It is widely expected that the Biden administration will seek to bump up that tax rate another couple of points, not to where it was beforehand, but somewhere in between. So let's say as of today, then you were to set up a cross-border arrangement that would give you no tax advantage at 21%, but a tax advantage at 25%. Then under this provision, that could also qualify. It does ask subjectively what your intent was, which is not really how the main benefit test works, but you certainly have to think it through. Anyway, so that's a summary of these tax benefits. Now, we're going to look now at the way some jurisdictions are limiting the volume of reportable cross-border arrangements through the enhancement of the main benefit test. And there's two ways we've seen them do that so far. And the first is what the UK has done. Their final regulations released on the 1st of July. The draft came out in either March or April. And they take the position that tax advantages do not count towards the main benefit test if they can, quote, reasonably be regarded as consistent with the principles on which the relevant provisions that are relevant to the cross-border arrangement are based and the policy objectives of those provisions. Now, this makes a ton of sense. There's a lot of legalese in the way they've drafted it, but in terms of a position saying if there's a state-sanctioned, state-encouraged tax benefit that you're taking advantage of, then the tax authorities don't need you to disclose information on that to them. They want you to do that. They encourage you to do it. It is public policy to do it. So if you're taking advantage of it, then that's not aggressive. That's standard. That's normal. In that sense, the tax benefit is not a bug of the tax code, but a feature of the tax code. And you should be encouraged as a taxpayer and advisors to pursue that to the full extent allowed. One of the examples they gave on how this could work would be tax relief for certain types of R&D, research and development spending under the UK tax code. So if you were to otherwise construct a cross-border arrangement, whose purpose was to finance research and development for your company, and as part of that, you were to get the tax break under the UK law for R&D spending. This is the type of tax benefit that can reasonably be regarded as consistent with the principles of this particular element of the tax code. And therefore, under the UK regs, the main benefit test is not met. Now, this seems to be, as in my lawyer's mind, the right way to formulate the enhancement of the MBT and therefore limit its application to cross-border arrangements under DAC6. But it's not the only way, and it is larded with legal ideas, reasonably consistent with. These are all things that ask for experts to weigh in on what is reasonable and what is consistent with, and people have to, of course, have a very full understanding of the tax code in order to assess whether a certain tax benefit is reasonably consistent with the principles of the entire UK tax code. The Dutch method of enlarging the main benefit test does away with some of the legal jargon. It's less lawyerly, it's less abstract, it's a much more practical, two-pronged inquiry. So all else being equal, the main benefit test is met only if, one, the arrangement would not have been implemented were the anticipated tax benefit not obtainable, or two, the arrangement features supplemental elements added to obtain the tax advantage in question. And then it closes with a thought experiment, which I think is supposed to condense the 2 points into a singularity. Whether it does that or not, I'll leave that up to you. But the thought experiment is an interesting approach to take. And it asks, if the tax benefit were revoked, would the implementation of the arrangement have remained the same? If so, the main benefit test is unmet. This seems like a practical and easy guide, but if you apply it to certain situations, you can see some of the flaws that may be inherent to the Dutch method of enlarging the MBT. So once again, let's consider the research and development scenario. So if in Holland, you were to enter into the same arrangement as the UK people did, so financing research and development through a cross-border arrangement, you would then apply this two-part inquiry to determine whether it meets the main benefit test and needs to be reported. Would it have been implemented were the anticipated tax benefit not obtainable, or were features, supplemental features, added to obtain the tax advantage in question? That will depend, of course, on the particular type of research and development you're doing and how critical it is to your business operations. But I can tell you, under the thought experiment, I really think that most research and development financing will meet the main benefit test under the Dutch standard. And that's because research and development financing, even with the tax subsidy attached to it, is still going to be based on your cost of capital, putting it in, and then what your minimum return of investment is, return on investment that you have in your business is. And if you have this much capital giving you this return, then you add the tax benefit and that capital goes down. The cost of capital to you goes down because you're getting a tax refund on it. Many people, what they'll do is they'll increase the amount of money they spend until the balance is back here on the return on the investment. And so in most situations, while it may not determine whether you make the investment to begin with, it will often have an impact in how much you invest into that particular research and development initiative based upon the tax advantage you expect to get. Now, it's not a question of whether the Dutch or the UK one is superior. I think it's probably premature to be making those judgments because there's so many factors that will go into it, not just whether it's correctly constructed in theory, but whether it can actually be operationalized. And you can see a sharp tension between these two particular approaches on those questions. But what I'm taking from this different approach is a different balance between whether the tax authorities want all the information that could be, all the examples of aggressive tax planning, even if it's at the expense of a huge volume of stuff that's uninteresting, or what I think the UK is trying to do is they're willing to except they're not going to get all the information that they would want, but they're also not going to get a deluge of information that they don't want. And that will presumably allow them to better focus on the issues that they want to focus on. So what they have done is, in order to reduce the false negatives to a manageable amount, in order to reduce the false positives to a manageable amount, they're willing to put up with some false negatives. The Dutch seem to have adopted a slightly different balancing approach, which is they'll take more of the false positives to make sure they don't get any false negatives. So everything that should be reported will be reported. It's only a matter of finding it amongst all of the other data that you've received. Which approach you prefer will come down to, I guess, the tax authority's risk appetite. It's again early to tell, but early to say who's winning. But last month, Luxembourg amended their regulations, and they basically adopted the UK approach to enhance the MBT. So as far as the scoreboard goes, it's basically 1-0 the UK over the Netherlands in terms of enhancing the MBT. But as I mentioned earlier, enhancing.
Yeah, absolutely. This is one.
I'm sorry, is someone asking a question, or someone could?
Yes, better. Okay.
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 Thank you. So as I mentioned at the onset of this section, enhancing the MBT is one way to reduce volumes of reportable cross-border arrangements, but not the only way. And the other way we've seen is the way that the Germans and the Irish have shaped their guidance. And they're basically trying to limit each of these reports on a hallmark by hallmark basis. So in these guidance notes or administrative decrees, they step through each of, not all of the hallmarks, but most of the hallmarks, and certainly the most interesting hallmarks. And they basically refine the interpretation through references to common scenarios that are presumably familiar to the people trying to apply these laws. They use examples that are probably frequently occurring in the financial industries in these jurisdictions. And then, and these examples will be both whitelist and blacklist. So you'll look at something and it will say, oh yeah, if you transfer money in Germany to an overseas subsidiary with a lower tax rate, that counts. They don't really give you any wiggle room. The Irish do something similar. They say, for example, if you're using insurance wrappers, that's a really strong sign that this is going to be a reportable arrangement. They don't say automatically, but they basically put a pretty strong onus on anyone who wants to say it's still not a reportable arrangement, even though we've used this particular example that they cite in their guidance notes. And then both Germany and Ireland, they end their, or they append to their guidance whitelists of commonplace non-reportable activities. Most of these, in the Irish case, these all apply to Hallmark A3, and I think most of them do in the German case as well. This is the, I take that, the substantially standardized documentation. So the incredibly broad Hallmark we discussed at the beginning, and in order to limit the reporting under that potential mammoth Hallmark, they add whitelists. The Irish whitelist is interesting. It's about 15 or 20 tax code provisions, some of which seem fairly obscure. I mean, one of them is about like the occupation of woodlands pursuant to section 22. No idea what that tax element is there. But basically any activity that is consistent with the provisions of these statutes or these provisions of the tax code are whitelisted, are automatically not going to be reportable for DAC6 purposes. Additionally, they provide further, they quantify certain qualitative terms. So as we see here on the bottom left of this slide, where it says a near 0% tax rate under Hallmark C1b I, basically it's 4% or less under German guidance. I've seen 1% or less in other guidances. So this is also fragmenting throughout the EU. Rather than leave it at near zero, they give you a red line that you're on either side of, or what a material difference in the price is under Hallmark C4. I won't try and synthesize that. It's a lot of numbers, but it basically says this is the amount, this is the percentage.
Florian, right.
Anything above that is a material difference and therefore would qualify under this hallmark.
Always in
So
office.
the advantages that we have from the German and Irish guidance is it's pretty.
Sometimes.
I'm going to stop here. Can I ask everyone to double check and please make sure that they're on mute? I can hear people in the background talking. Can everyone please check that they're on mute? Thank you. So the advantages of the German and Irish approach, I mean, clearly it's administratively easier. They make things, there's no reasonably consistent principles of, there's no thought experiments. It's clear. Did you use a wrapper? Did you transfer funds, receivables to an overseas subsidiary? You know, based on common non-legal, non-DAC6 terminology, whether you did or did not do that, and are therefore automatically in or not for DAC6. It's detailed. You go through and for each one of these hallmarks where they think their needs, refining of the interpretations through examples or through refining some of the terms, they specifically do so. And so by reading it, what's relevant to you, you should know just from the text on the page what is important. And the third one is it's more dynamic. They can amend these regulations based upon feedback, based upon information they collect, based upon changes in the...
No, there are two topics. One for the specific email, I asked Hannah Michaela to...
I'm so sorry.
Friday.
I'm so sorry. There's someone talking.
Or Michaela for sure tomorrow. So now normally at least
can you please be quiet, sir? Whoever talking, we can hear
one
you.
Of them should come. Then if it was
as host, you should be able to mute him.
Okay, thank you. I just don't know.
More in general, not what now.
Yeah, I figured it out. Thank you, whoever said that. Okay. Sorry for the interruption. So dynamic as well. So the Irish and German authorities can adjust these guidelines or issue FAQs that can expand or contract what their interpretations, their whitelist, their examples are. So this can be considered the initiation of the whitelist approach. That gives them a great deal of control and allows them to be responsive to developments within the marketplace. Now, what about the negative of the limitation via the hallmark approach? And this is vis-a-vis, of course, limitation via the enhancement of the MBT. Well, they are pretty blunt. They basically seek to carve out large chunks of reporting based upon the substance of it. So, for example, it doesn't matter how you maybe structure, how the different elements interoperate, as much as do you have something where you've transferred these receivables overseas. There's no way that transaction can be set up in a way that doesn't make it reportable, even if there are elements that would make it not aggressive tax planning. And so in this way, it's very blunt. It's a blanket exception or inclusion of certain types of activities based upon their content, rather than based upon what they're actually seeking to achieve. Another con to this approach is that it's extremely localized. All these references are to local tax codes, local tax customs, local business activities that may not be accessible and understandable to someone who's not based in that jurisdiction, which is a little bit difficult for a common customs market with a common tax program like the EU. And then finally, it invites a certain amount of, let's call it home cooking. So you'll see where in the Irish guidance especially, there's certain activities that are reframed in a way that just happens to be beneficial for certain Irish financial industries that are prominent there. Whereas in the German one, they're much more interested in forcing people to disclose. And in the Irish one, they're maybe more interested in letting them not have to disclose. And you can see maybe there, the difference is of importance in the financial markets in these jurisdictions, but also specific industries within the financial market. And we could talk a little bit more about what that home cooking consequences as we get towards the end of the webinar. Now, I've said there are two ways of limiting the volume of reportable cross-border arrangements under DAC6 that we've seen: enhancing the main benefit test and specifically limiting each of the individual hallmarks. But of course, there is a third way, and that's combine them into both, a hybrid regime. And I've only seen one jurisdiction do this, but I like the results of what I've seen. And this is in the Cyprus guidance. And I'm not just kissing up to Cyprus because we're a Cypriot company. I really do think their guidance is outstanding. And what they've done here is they've enhanced the MBT somewhat, with a nice little mathematical formula, or they've allowed you to enhance it, but they've also they've also taken many of the ideas and themes from the Irish guidance, and they've reframed or paraphrased it, and then, well, let's say adopted a similar approach to what Ireland has done. So they actually try and create a mathematical formula for the main benefit test. What this formula calculates is what is the amount of tax due with the arrangement in place in effect. Really, what did you pay in tax? Yeah. Then you're supposed to calculate what the amount of tax that would have been owed if you hadn't entered into the arrangement, right? Then you take the difference between the two, and with that difference, you can contrast that with the overall profitability of the arrangement in question. And maybe then you would apply a minimal threshold, 10%, 5%, 20%, and say, anything above that threshold, if the tax benefit is higher than 20% of the total profits from this arrangement or total revenue from this arrangement, then it's one of the main benefit tests. Anything less than 20, 10, 5%, not one of the main benefits. Now, so it gives you something mathematical. Numbers don't lie. Have we heard that recently? Numbers don't lie, but it allows you to quantify what it means for something to be a main benefit. Now, this could be a little bit blunt. Perhaps certain arrangements, the main benefit should be set at 5%, for other ones, 20%. So probably you want to apply a little tax expertise sophistication to where you set the limit, the threshold for each type of arrangement. But of course, you want to be very careful about not always moving that threshold so as to just come underneath it each time you do the calculation, because then, of course, you'll be accused of cherry picking and you will discredit the entire approach you've adopted. But in any case, as a baseline, I think it's a very helpful mathematical formula in the Cyprus guidance. I do not know how well it will unspool as it actually comes into practice, but it's an interesting idea, I find. They don't stop there, though. As I mentioned before, they do similar to what Ireland has done to define each hallmark in a fashion that is appropriate for, understandable to, and possibly advantageous to Cypriot financial firms. They do not have the extensive whitelist appended at the end that we saw with Ireland and Germany. And then this was an interesting, and for certain domestic tax regimes, it makes clear that domestic being Cypriot tax regimes, that they do not qualify as preferential regimes per hallmark C1D, so long as the EU Code of Conduct Group business taxation did not judge them to be harmful. By coincidence, one of the major sources of foreign direct investment or incoming investments into Cyprus has to do with some Cypriot companies that have very favorable dividend treatments there. This preferential regime was looked at by the EU Code of Conduct Group business taxations and was not judged to be harmful. So this is quite self-serving in the Cypriot case, whereas if you look at the German notes, they say, just because the EU Code of Conduct Group business taxation did not judge a particular regime to be harmful, does not alone mean that it is not a preferential regime. So here you can see the givers and the takers, cultivating and contouring their guidance to the benefit or to serve their overarching interests, rather than seeking to harmonize one approach that will apply universally across the EU. Okay, so that covers the guidances that we've seen, a handful of the guidances we've seen, and ways in which certain EU member state jurisdictions are looking to limit the volume of reportable cross-border arrangements. So we're going to close out my portion of the webinar by talking about what the consequences and key takeaways are for the people who are listening to this webinar. The first one is it's the elusiveness of a common solution. We think that the EU has a common purpose, common objective with DAC6. They purportedly want to collect information on tax planning schemes, aggressive tax planning schemes, but all of them, and then they'll decide what's aggressive, as they are emerging. So before they become too widespread. So hence the 30-day reporting deadline. So they can see the information, they can spot these trends in the marketplace, and they can react to them before too many people have exploited the same loophole in the tax codes of the EU member states. The concern about all these different methods is there's no common solution. So they haven't got together and said, okay, we think this is clearly the best practice in which to do that. It looks like a lot of people are trying a lot of different things, and that's always a bit worrisome from the tax perspective, because it means that if you have 3 solutions to one problem, probably 2 of those solutions aren't going to work at a minimum. Point number 2, or key takeaway number 2, we're seeing the different priorities on the intermediary disclosure regimes across the DAC6 countries. We talked a little bit between the UK and Holland, the false positives versus false negatives, and what trade-offs are you willing to make in order to further the efficacy of your intermediary disclosure regime. We're also seeing some of the home cooking in the Irish and the Cypriot guidance, and even in the German guidance. It just looks cleaner there, where they are refining the interpretations in a way that is self-serving for that particular jurisdiction. Nothing surprising about that, but if you are talking about a pan-EU regime, it creates disharmonies throughout the regime. And this is maybe the biggest point, is it's further fragmentation of the unified EU DAC6 regimes. It's really, we're looking at this point somewhere between, instead of one regime for 28 member states plus the UK, something like that, we're like somewhere between 6 and 12 regimes at this point, which is just going to make the compliance activities of all of the affected parties ever more complicated. And it also opens up the possibility for DAC6 competition, where the more you can bend the interpretations in the rules, the more friendly you can make it to taxpayers, intermediaries for certain activities. And you can start using DAC6 to compete against other EU member states in order to bring in more business. This has 2 consequences, 2 subsequent consequences to it. It's a significant burden for the intermediaries with operations in multiple EU jurisdictions to keep track of all of the variations, the divergences amongst the various EU DAC6 subregimes. And it will encourage forum shopping. If you know a certain activity is reportable in Germany, but not reportable in Ireland, then maybe you hire the Irish lawyer to give you the advice on it, not the German one, or the Irish accounting firm to be the intermediary there, not the German one. And this forum shopping, once the EU cottons on to the fact that its citizens are forum shopping under DAC6, they will then come out with anti-forum shopping measures, which will add a whole nother layer of complication to the implementation of DAC6, a meta regulations for what's already a set of meta regulations. And then the final question is, at some point, does this all just become a recipe for chaos, that there is no unified regime, but so many different regimes that there was no point in having a single one to begin with. So that was fun. I have a question here from John Shoemaker. Paul, do you think providers will be able to request a report of those matters for which they were reported as an involved party? That's a great question. So thank you, John. So if we scroll back to the very onset, one of the things I mentioned here is that as part of the reporting duties, you not only disclose specified information about the transaction, but all the parties involved in it. And John's wondering if those parties who are reported, maybe unbeknownst to them, being included in some of these reports, if they will have any right to look at the materials, look at anything, any reports where they where their name was mentioned. I have not seen anything to that end yet, John. I've not seen anything affirmative saying, and yes, if you're reported, you can get in touch with us and we'll let you know if you have or have not been reported. And if you have, we'll give you the information. And your question is, would it take place under GDPR automatically and outside of DAC6? I bet people will challenge it based on GDPR. They seem to challenge any tax disclosure regime based on GDPR. And if it was a limited challenge to just getting information about what was being reported about them, I could imagine that would be a successful challenge. But it's beyond my ability to project right now exactly how that would go. So just to answer your question, I have not seen anything specific to DAC6 saying you can collect that information. Anna, have you seen anything? No, Anna's shaking her head too. Anyone on the call seen anything? Feel free to send a note or chime in. But at the moment, no, there's nothing that would allow you to get the information about yourself that had been reported or about your company, as the case may be. Thanks for the question, though. Before I hand over back to Anna, we will have a Q&A session at the end, but if anyone has any questions they'd like to present right now, feel free. It's a good moment. Okay, then I'm going to slide it back over to Anna for closing remarks. Oh, for Q&A. I guess we're in Q&A then. So does anyone have any other questions or comments or thoughts on anything we've talked about thus far today? Okay, then I am going to hand back to Anna for closing remarks. Thank you, everyone, for your time and sticking through the presentation.
Thank you, Paul. Thank you all for staying with us online. We have 2 more minutes, so I'll try to keep it short and sweet. We have 2 more upcoming webinars with Bluebridge. So the next one is next month on the 16th of December, and it's to do with the specifics of DAC6 in Cyprus. So if you are operating in Cyprus or have anything to do with the Cyprus, then you're very welcome to join us, and we'll provide insights to the regime. And the next one that we have, the last one in our series, is in January 2021. So that's on the 21st of January, and it's to do with the specific impacts of DAC6 on fiduciaries. So here, what we will talk about are direct and indirect impacts of the DAC6 directive and local rules on the fiduciary industry. So if you are EU fiduciary, by all means join the webinar. If you're international fiduciary with clients in EU jurisdictions or taxpayers in EU jurisdictions, please join us as well, and I hope you will benefit from it. So if you have any questions to that webinar after the webinar, please get in touch with myself or Paul. If you have questions to Bluebridge or our services, by all means visit our website or get in touch with us as well. If there are not, we have a question about the slides of the webinar. Yes, we will be able to distribute those. Thank you, Louisa. And yeah, if that's all from your side.
You want to mention the video?
Yeah. We will also have, yes, good point, Paul. We will also have a video of that presentation. So if you want to replay it and listen to the technical part, you will have access to that as well. So with that, thank you, everyone. Have a great afternoon, and hopefully to see you on the 16th of December or 21st of January. Thank you, and have a lovely afternoon.